$6 trillion. That's the kind of number economists usually toss around when they're talking about an entire year of American growth. Yet on a single unremarkable spring Monday, it evaporated in the time it takes to finish a latte. No hackers, no hurricanes, no Hollywood-style sabotage. Just one man, one signature, and a brand-new tariff wall tall enough to blot out Wall Street's skyline.
For decades, our country has been looted, pillaged, raped, and plundered by nations near and far, both friend and foe alike. American steelworkers, auto workers, farmers, and skilled craftsmen. We have a lot of them here with us today. They really suffered gravely. They watched in anguish as foreign leaders have stolen our jobs, foreign cheaters have ransacked our factories, and foreign scavengers have torn apart our once beautiful American dream. We had an American dream that you don't hear so much about. You did 4 years ago, and you are now, but you don't too often, and for many years and decades even, you didn't hear too much about. Our country and its taxpayers have been ripped off for more than 50 years, but it is not going to happen anymore. It's not going to happen. In a few moments, I will sign a historic executive order instituting reciprocal tariffs on countries throughout the world. Reciprocal, that means they do it to us and we do it to them.
Some called it economic patriotism, others a self-inflicted wound. But everyone felt the jolt. Retirement accounts shrank faster than a cheap cotton shirt in hot water. CEOs scrambled to rewrite earnings guidance, and the trading floor of the New York Stock Exchange turned as silent as a church at midnight. But here's the kicker. The real story isn't the plunge itself. It's the obsession, decades in the making, that set the dominoes teetering. Stick around, because what triggered the Black Hole Monday is only the first twist in a saga that keeps getting stranger. Veteran traders have seen their share of panics. .com, housing, pandemic, but none had witnessed a drop that steep, that synchronized.
Many of his own advisors and Wall Street allies view it as humiliating. It is something that will not only affect so many people in our country and around the world, but even if you look at it by narrow terms of just the president's record in history, this is now the blemish on his record, not only for the second term, but forever. The record is the self-inflicted choice to wipe out this much value in the stock market over just 2 days. We've been reporting how people are holding onto their hats during this tariff-inflicted meltdown over the last day. Well, tonight as we end the week and have a whole nother day of markets, the U.S. stock market has now lost $6.4 trillion in just 2 days. This is Trump's trade war. We are losing because of Trump, because of the choices he's made. The market's tanking. Recession fears deepening. And of course, it's the economy stupid. This is not something the Republican Party will be able to lie out of, or to pardon their way out of, or to trick people into thinking that all of the problems they have, from rising prices to job fears to rising costs, that they're not real or they're somebody else's fault.
By the closing bell, the Dow bled 13%. The S&P gave up 11%, and the tech-heavy Nasdaq looked like it had been tossed from a moving train. One hedge fund manager compared the carnage to watching your parachute tear in half at 10,000 feet. Margin calls fired like machine gun bursts, safe haven bids pushed Treasury yields to a record low, and even gold, normally the panic button's best friend, barely moved because traders needed raw cash to meet obligations. The White House tried a quick damage control presser, insisting the slide was temporary turbulence. Investors weren't buying it. The sell-off spilled into Asian and European sessions, wiping an additional $1 trillion before most Americans even brewed their morning coffee. And the reason? A tariff barrage so broad, it made the Smoot-Hawley Act of 1930 look like a parking ticket. But tariffs don't appear out of thin air. They spring from a philosophy, and this one traces back to the glossy pages of an 80s tabloid. Long before the Golden Escalator ride, Donald Trump waged a one-man war against what he dubbed economic surrender. In 1987, he took out full-page ads in the New York Times scolding Japan for laughing at our stupidity while flooding Fifth Avenue with VCRs. Fast forward to campaign rallies where he pledged a beautiful 10% blanket duty on everything entering U.S. ports. Milk, microchips, mangoes, you name it. Advisors begged for nuance. He wanted a battering ram. When staffers floated concerns about consumer prices, Trump reportedly quipped, "If people can afford Starbucks, they can afford America." The obsession matured into policy on Tariff Tuesday, a tiered system starting at 10% for allies, ballooning to 54% for China, and laced with one-off spikes, 20% on European cars, 40% on Vietnamese textiles. To supporters, it was long overdue reciprocity. To critics, it was economic Russian roulette.
Ford sells very little. None of our companies are allowed to go into other countries. And I say that friend and foe. And in many cases, the friend is worse than the foe in terms of trade. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Thank you. Brian, I'd like to have you come up here for a second, okay? I just see him sitting. He's been a fan of ours, and he understands this business a lot better than the economists, a lot better than anybody. Brian, say a few words, please.
Yet, in the Oval Office, the plan looked like a victory parade waiting to happen. Until steel met reality. Steel is the skeleton of modern industry. Cars, bridges, refrigerators, even the bolts in your kid's swing set. Hike the price of steel by 20%, and the ripple reaches every checkout lane in the country. Detroit felt it first. General Motors quietly canceled weekend shifts at its Arlington SUV plant, citing unforeseen material costs. Ford paused a $900 million upgrade to an electric truck line and moved the ribbon-cutting indefinitely. Over in Illinois, a supplier that stamps door panels for 3 automakers furloughed half its workforce with a grim note. Tariffs ate our margins. Showrooms started slapping $44,000 stickers on SUVs that had cost $40,000 just weeks earlier. The jump might not sound lethal, but economists say every 1% price hike sidelines roughly 40,000 potential buyers. Multiply that by 4, and you're staring at a ghost town dealership. Meanwhile, union halls filled with nervous chatter. Is this protection or a prison fence built around our jobs? And while the Midwest grappled with factory silence, amber waves of grain faced a different kind of hush. Picture miles of soybean fields shimmering under the sun, each acre a tiny bet on a handshake halfway around the world. For decades, Beijing bought 1/3 of America's soy harvest. After Tariff Tuesday, that handshake froze mid-air. Chinese importers pivoted to Brazil. American silos filled beyond capacity, forcing farmers to store beans in makeshift plastic tubes snaking across the prairie. Soy prices cratered 15%. Cotton slipped 10%. Wheat, 8%. Farm income fell so sharply that rural banks dusted off. Foreclosure paperwork last used during the 1980s debt crisis. In Iowa, a convoy of 200 tractors rolled to the state capitol, horns blaring, signs reading, "We grow, you blow." One grower summed up the mood. "We were promised a seat at the table. Instead, we're on the menu." The ripple wasn't confined to crop rows. Equipment dealers saw orders vanish. Local diners lost breakfast crowds, and small-town newspapers shrank from daily to weekly print. But the pain didn't stop at the county line. It followed every family into the supermarket. If you think tariffs only ding importers, check your grocery receipt.
I'm a little afraid that the price will be going up, which means a higher car payment with me, and I have 2 little kids, so that's going to be a little hard for me too.
As a small business, we can't absorb that kind of increase in product. So we're having to reprice.
In one word, how you're feeling about what's happening in the stock market right now?
Anxious? Yeah. I mean, it's not too clear what's going to happen.
Terrified.
Why terrified?
Vulnerable people were always unsafe, and now they're made even more vulnerable.
Eggs at $7 a dozen, cereal up 6%, gasoline flirting with $5 a gallon. 2 separate studies pegged the average household hit between $3,800 and $5,200 a year. Supply chain. Analysts warn the flagship smartphone could break the $2,300 barrier if levies linger. Parents are choosing between new shoes and school field trips. Young professionals downgrade streaming subscriptions to keep the lights on. One Chicago barber joked, "My clippers cost more. My cape costs more. Soon I'll be charging extra just to listen to your problems." Humor masks anxiety. Inflation eats wage gains, and the Federal Reserve's toolkit looks blunt when the spark comes from tariffs, not overheating demand. Yet, behind the price tags lies an even stranger tale, the equation that set those numbers. The ripple effect also reached services like healthcare, with hospitals reporting increased costs on imported medical equipment. Dental clinics saw the price of basic supplies jump, and patients noticed higher bills with little explanation. Small businesses, especially retailers that source from abroad, were left with little room to breathe. Many either cut staff or raised prices, both of which caused local economic contraction. In this environment, every spending decision becomes political, every purchase a reflection of survival. Most trade policies emerge from rooms packed with PhDs running dynamic stochastic models. This one, insiders claim, started on a scrap of paper. The rule: take America's trade deficit with country X, divide by total imports from country X, convert to a percentage, and voila! That's your tariff rate. Sounds tidy until you realize it ignores whether that country already charges low duties, buys American goods, or even posts a U.S. trade surplus. Vietnam, with modest tariffs and growing Boeing orders, suddenly faced a 46% wall. Cambodia, barely on Washington's radar, got slapped with 49%. Meanwhile, nations infamous for non-tariff barriers skated by with single-digit penalties, because their numeric deficits looked small on paper. Economists labeled the method idiotic. The Financial Times called it policy by improv. And allied diplomats whispered, "If this is reciprocity, what does revenge look like?" We didn't have to wait long for the answer. Behind the scenes, think tanks scrambled to understand the logic. Their conclusion? There wasn't any. A former U.S. trade representative anonymously said, "It's not a formula. It's a grudge masquerading as math." The randomness of it meant businesses had no predictability. And in global trade, uncertainty is poison. It stops investment, halts hiring, and triggers a shift to safer, friendlier markets. Canada fired the opening salvo within 72 hours. Ottawa's counter-tariff list read like a Midwestern grocery order: orange juice, ketchup, lawnmowers, even Kentucky bourbon. Total value: $30 billion. More surgical was the 25% duty on DDT, U.S. cars that failed to meet the USMCA labor threshold. The Windsor Assembly Plant, once humming with minivans destined for American suburbs, shut down for 2 weeks. 3,600 paychecks paused. Europe targeted Harley-Davidson motorcycles and Levi's jeans. Japan hinted at rare earth mineral quotas. China quietly tested export controls on lithium batteries. Global supply chains, already brittle from pandemic aftershocks, began snapping like dry twigs. Cargo ships idled at ports, unsure whether offloading fees were worth the risk. In Brussels, one trade official quipped, "The U.S. just pulled up the drawbridge and forgot its businesses are still outside the castle." Inside the West Wing, though, retreat was not on the menu. The retaliation didn't stop with products. International sentiment soured. Cultural boycotts emerged. Canadian supermarkets proudly displayed "No U.S. goods" signs. European tourists canceled American vacations. Even sporting events saw quiet protests, with American teams receiving frosty receptions abroad. What began as an economic disagreement was snowballing into cultural fallout, a soft power crisis that America hadn't seen in decades. With markets still woozy, advisors floated an even bolder stroke, a 60% blanket tariff on every product stamped "Made in China." The talking point was simple: crush dependence, revive factories, win votes. Trade scholars ran the numbers and nearly spilled their coffee. Imports from China could collapse 85%, yes, but consumer prices might surge another 7% overnight, and recession odds would jump to coin-flip territory. Wall Street warned of a second, deeper sell-off. The bond market began pricing in a flight-to-quality stampede. Yet rallies in Rust Belt towns cheered the idea, waving "Bring It Home" banners. The nation seemed split between two dreams, one of reborn smokestacks, the other of affordable living. The only certainty, another twist, was coming. Manufacturers in Southeast Asia began preparing for opportunity. Vietnam, India, and Bangladesh saw an uptick in inquiries from U.S. companies desperate to reroute supply chains. However, shifting production isn't like flipping a switch. It takes years, billions in investment, and a stable policy environment, which the U.S. was no longer offering. Instead of reshoring, many companies considered diversifying away from the U.S. altogether. What began as a single nation's attempt at recalibrating trade quickly spiraled into something far more complex, a global chain reaction that has yet to be fully understood. While headlines focused on immediate dollar losses, the more enduring impact could be the reprogramming of how the world does business with the United States. Countries that once leaned heavily on American demand began to diversify. Trade blocs like ASEAN and the EU ramped up internal trade. China turned more aggressively toward Africa and Latin America, offering favorable terms in exchange for loyalty. Multinational corporations, tired of the uncertainty, began setting up satellite hubs in more politically stable nations. Ireland, Singapore, and the UAE saw record spikes in corporate relocation inquiries. The message from the world was clear. The U.S. may be powerful, but it's no longer the only game in town. And if Washington keeps rolling the dice, others are, ready to build their own casinos. Domestically, the aftershocks crept into unexpected corners. Local banks faced tightening liquidity as loan defaults crept up. Municipal governments, reliant on tax revenue from once booming factories and businesses, suddenly faced budget crises. Teachers were laid off. Infrastructure projects were frozen. Pension funds posted their worst returns in a decade, forcing emergency recalculations in several states. At the individual level, the psychological damage proved just as costly. Consumers became more cautious. Home improvement plans were shelved, vacations postponed, major purchases deferred. In a consumer-driven economy, this collective hesitation acted like an invisible brake, grinding momentum to a crawl. Even those who still had jobs and savings found themselves second-guessing every financial decision. And amid it all, the political divide widened. Supporters of the policy doubled down, convinced the short-term pain would yield long-term gain. Opponents pointed to the economic wreckage as proof of reckless leadership. Town hall meetings grew more tense. Social media, already a hotbed of polarization, exploded with hashtags and misinformation. Civil discourse eroded further. This wasn't just an economic shift. It was a psychological one. The belief in stable, rational governance, the idea that policy was guided by data, expertise, and deliberation, had been replaced with something more volatile. The market didn't just fear the policy, it feared the unpredictability. In the years to come, textbooks may reduce this moment to a case study on trade wars and economic policy, but those who lived through it will remember more than graphs and GDP slides. They'll remember the canceled plans, the sleepless nights, the quiet dread that maybe, just maybe, the rules that held the economy together weren't as solid as they'd once believed, because tariffs can be lifted. Markets can recover. But trust, especially trust in leadership, is far harder to restore. Tariffs look like armor, but every new plate adds weight. Wall Street felt the burden first, the assembly line next, the grocery aisle soon after. Allies turned adversaries, supply chains kinked, and the global economy caught the sniffles that start pandemics of panic. Could the gamble still pay off? Maybe. A handful of steel mills rehired, a couple of shuttered tool factories flickered back to life. Yet even the beneficiaries admit they're one policy pivot away from extinction. The bigger question looms over every dinner table. How much are we willing to pay, literally, to find out whether this experiment ends in renaissance or reckoning? Because if 6 trillion can vanish before lunch, imagine what the tab might look like by dessert. Ultimately, America faces a choice. It can double down on confrontation, risking isolation in a world built on cooperation. Or it can recalibrate, recognizing that strength doesn't come from walls, but from bridges. Until then, every imported t-shirt, every grocery bill, and every missed job opportunity is a receipt. And the fine print reads, "Paid in full by the American people."